Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from Philadelphia, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker dealer. That's what they're there for, to give you advice, provide you with guidance. There's a disclaimer.
Excellent.
And I'm going to share my screen. While I'm doing that, if anyone is joining us for the first time, Will and I, we do this show in the morning to help answer questions about Market Chameleon tools, data, analytics. If you want to come on a show and ask your question live, we provide a link to Zoom. It's in that live chat on YouTube. Click on that. It takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once you're in there, everyone could hear you. You could ask your question directly, navigate as to what you're looking at. If you prefer to type in your question, you could also do that on that chat box on YouTube. Type in the question in there. Will's watching it. He'll read it back to me. And while we're waiting for questions to come in, we'll start taking a look at the pre-market report to see what's trading in pre-market hours, get some insights there. If we don't get questions, I do have, I'll go to default to some questions that I get through the email or through previous chats. And we could also just navigate to a different part of the website, see if we could get any kind of insights from different reports. So we'll start out with the pre-market report, Will, and let me know if you have any questions coming in.
Perfect.
So, the pre-market report. These are stocks trading in a pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Down here, I see 177 stocks made our percentage gainers list, 52 on the decliners. So from this perspective, right now, we're lining up for more bullish bias at the open. If you look at this list, you'll see that there are small cap stocks in there. We have leveraged products, ETFs, a preferred stock, closed-end fund, anything really that's listed on the major U.S. exchanges. If it's trading in pre-market hours and meets our thresholds, it can make this list. So we want to filter this list down or narrow it down to a smaller group of stocks to see if we could get a little bit more focused insights. And to do that, I'm going to use the filters up here. Here's an ETF. When you click on it, you drop it down, you get a list of ETFs to pick from. The top ones are broad-based ETFs. The other ones are industry sector ETFs. And let's pick SPY. That's S&P 500 ETF. Clicking on that. And when you do that, the tables below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 53 stocks made our percentage gainers list, one on a decliner. So right now we are setting up for a more bullish bias at the open. And, I think the bank stocks are still kind of at the top of the list of, market drivers right now and what's going on. And it looks like, the Fed, the Treasury, they're very active trying to calm down fears of the banking sector, the financial sector, and they're looking at ways to basically, how do you expand insurance, either expand it to a higher number than 250,000 or just insure all deposits. But whatever they have to do, they're trying to contain it so that fear does not spread throughout our banking system. But they are talking about it, and I think that they're going to do whatever it takes, and that's calming markets for the most part. I think that markets are kind of a little bit more confident here, and in a way, this crisis also had some stimulating effect to the economy, right? Because interest rates dropped dramatically. So now you got, the 10-year down, that the 2-year, the 5-year, all those interest rates have dropped. Oil prices came in. The Fed opened up liquidity window, with access to capital from the Fed. So in a lot of ways, what happened to SVB, stimulated the rest of, the economy, because of the reactions of the market.
I guess the question is where's inflation in 6 months,
That's
7 months from here?
Right. That's the other question then. If it happens so fast that, we didn't, the SVB, it happened so fast that really there was no deflationary pressures that I see from, in the consumer prices from it. Maybe, oil prices sold off. So that's a good thing, and oil is very connected to the financial sector because, there's a lot of credit going on over there. So oil prices did come off, but I don't think it was long enough to really create deflationary pressures throughout the economy. And the Fed came out and really threw a lot of liquidity back out into the markets, but with opening up their window to all these banks. I think something like $160 billion was accessed already through those banks, and and now looks like they're just going to ensure deposits maybe across the board. So I think that's stimulative, because now they're providing that insurance that didn't exist, and now you have interest rates that are much lower than they were a couple weeks ago. So all that is stimulative. By the way, and oil prices coming down is stimulative to the economy as well, right? Because if you're spending less on that, you could spend more money on something else. We had a question about credit default swaps. So maybe what I'll do is touch on that. And then if we have more questions coming in, you'll let me know. All right. And I think you're on mute. So the question
we did have a question from Rob popping in. He says, is there a volatility filter on any of the screeners?
A volatility filter. We have different types of volatility filters. Maybe like what kind of volatility filter?
All right, Rob, just let us know what type of volatility, I guess, implied volatility, historical volatility.
Yeah. Volatility ranking, while maybe we get a little bit of clarity from that, what I'll do is just touch on credit default swaps, because the question was, what are they? What is a credit default swap? And why is it important? Why can it seize up? Why can it seize up the financial system? And what a credit default swap is. And I'm not a bond person. Okay. I never really traded bonds. I've invested in bonds, but I really never traded them. I don't have models to really price them. I could just tell you from a general viewpoint what these are. Okay. So I'm not an expert in pricing credit default swaps, trading them. These are over-the-counter instruments, but the basics of what credit default swaps are. And when you look at a bond, I'm going to use my paint. When you look at a bond, right, you have one bond that everybody uses as the benchmark, which is the Treasury, right? So Treasury we use as the benchmark because it's considered risk-free, right? Because risk-free from default, because the US government guarantees those bonds, right? And they could print money. So if they could print money, that means that they're considered that they're not going to default. If they don't have it, they'll just print it, right? And let's say you have a treasury that I don't know, pays 4%, right? So let's say we have a treasury that pays 4%, and we'll call it, 10-year treasury. So if this is the benchmark, right, we have other bonds out there. So what is a credit default swap? The credit is the borrow and loan markets, right? That's credit. It's not like equity where you're a shareholder in a company, and you own part of the company. Credit is you're lending money to somebody, right? You're lending it. You're not an owner in the company unless the bond has a convertible or whatever, but you're just lending money at an interest rate and getting that money back later. So that's the credit part, right? But so what's the default part? So let's say you have other bonds in there, and we issue a lot of, these are big, that credit market is much bigger than the equity market. Companies issue bonds and credit, so do municipalities and local governments and states and cities. But let's just I'm going to use just IBM, right? Let's say IBM also has a 10-year bond, and it's competing with the treasury. And let's say IBM bond pays 5%. Well, why is the IBM bond paying more interest than the treasury? Well, because IBM has an extra risk, right? And this is the risk premium, right? Or sometimes yield, whatever you want to call it, premium. So what does that mean? Well, IBM, has a risk that it could default on this bond, right? Because IBM is a company, and if the company does not make enough money, if it doesn't, if it runs into trouble, there's a risk that they may not be able to pay you back the principal, right? Not even the interest. They might not be able to pay you back the principal. So they borrowed whatever from you, $50,000, they're paying you interest. They might not be able to give you the $50,000 principal back at maturity. And that's the default risk that IBM has. And there's a premium for it, right? In other words, well, if I have default risk, right? If I have default risk, I should get a premium for taking that risk. I should get paid more. So typically what you'll see is that, bonds that, you compare them to the treasuries, and for similar bond in a corporate, municipality, whoever can run into trouble and default, they pay a higher premium. They have to pay, more interest to take on that risk. So now you're getting 1% more a year to invest in, let's say, a corporate bond over treasury. Well, and by the way, that's one of the risks of the bond, right? You still have interest rate risk if interest rates go up or down, but let's just talk about the default, this credit default swap. So one of the risks is forget about the interest rates, forget about duration and fluctuation of interest rates. You have a risk that they're going to go out of business. They could default and not pay you. So some people, they'll say, look, I don't want that risk on. right? I don't want the default risk. I'm willing to take the interest rate risk, but I don't want to carry this default risk. So what if I paid somebody else to take on that default risk? You basically buy insurance. In other words, what if you paid this 1%, right, per year? You just paid it to somebody like AIG, who insures, who sells these. And in case of a default, in case IBM defaults, you go to AIG and they make you whole on your principal. So they pay you back your principal, right? So you're swapping with them your risk of default. So whoever is insured, whoever bought your credit default swap, they don't get the interest on the bond, right? They don't even hold the bond, but you're giving them, you're paying them, like say an insurance policy, that in case something happens and there's a default, if they're, and they have to calculate the likelihood of that happening, but let's say in the unlikely scenario that this company defaults, then they have to make you whole on your principal. Okay. And, let's say if you paid them 1% of per year, 1% per year for your default, then you would equal out with the treasury, right? All of a sudden, this should be paying 4%. This is paying 5%, but you're giving 1% back to the credit default swap, and then there's no premium left. Of course, it doesn't exactly work that way. That's in a perfect world because, well, whoever you buy a credit default swap from, well, there's a counterparty risk. So they could go out of business too, right? So think of in 2008, not only, were people now in danger of, their bonds defaulting, but their insurance policy, their counterparty risk, they're going to go out of business, so you can't collect from them either. So not only did you lose on a bond, you lost on your insurance. So usually, there's a spread there, right? Maybe, 0.5%, right? That you're taking for somebody else to take your default risk off the table. Okay. And they're just willing to sell you that insurance because they think that it's not likely, or you're paying them enough that over the long term, they're collecting enough premium to offset any types of defaults they might encounter. So that's a, simplified version of a credit default swap. Okay. Here, let me title it up here. Credit default swap, right? Credit swap. And sometimes for, someone like IBM or municipality, to make it more attractive to investors, they might go out and buy those credit default swaps, right? They might just attach it to the bond. And there are different terms to them too. So it's not very straightforward. It's not that simple, because these are contracts that are traded over the counter. They're negotiated. You have to read the clauses. It could maybe only protect you for a certain percentage of the default or principal, like maybe 80% of your principal is protected, right? So that will bring this down, maybe 90%. So you might be willing to take the first 10% haircut, and then the 90% is insured. So think of like a deductible on your car insurance. The first $500 you're willing to accept, right, for lower premium. If you're willing to accept the first $1,500 in damages out of pocket, then you're going to pay a lower premium. So all these, are over the counter. You have to read these terms and make sure that you're okay with it. But those are credit default swaps, basically trading around there, and they become an important part of the credit markets because people rely on those credit default swaps to price these bonds and feel comfortable investing in some of these bonds. Whether it be in a corporate bond, whether it be in even a municipality, but they rely on that market to be very liquid because they want to ensure their default risk, makes them more comfortable holding that portfolio. And then they limit their bond holdings to the interest rate risk. By the way, you can swap that as well. So you could swap out floating rate for fixed rate, but let's just stick with this, the credit default swaps. And if the credit default swap seizes up, it starts to seize up some of the credits. People get nervous and they're like, hey, if I can't even insure these anymore, maybe I should just stay out of it. And that creates more friction in the credit markets, right? Imagine all of a sudden you couldn't insure, you couldn't buy insurance on your car, or you couldn't buy insurance, healthcare insurance, or you couldn't buy insurance on your house. Those markets start to seize up because people get nervous about stuff, and then the activity in there, the pricing becomes more volatile, right? The demand for premium goes up. There's less liquidity, less commitment of capital into those markets. So the credit default swaps, have become an important part of those credit markets. So the question was, well, if there's an issue with the credit default swaps, why would it impact the rest of the credit markets? And that this is why. Because outside the treasuries, which is the benchmark, right, you have lots of other players. I'm just using IBM, but obviously you have lots of other players accessing our credit markets that are borrowing money for business operations, borrowing money to conduct even government services or make investments, and the credit default swaps are an important part of that market. So ensuring the risk of default makes people more comfortable. They don't have to at least take that risk off the table, and they don't have to continuously watch. Once they insure it, they don't have to continuously watch and pay attention to, am I at risk that the creditor is going to default and not be able to pay the principal back on my loan? So hopefully that helps answer, the credit default swap question.
Yeah, people really enjoyed that discussion, Dee. Rob did ask, and I think was this one of the big reasons for the market turmoil in 2008?
So yeah, so what
and
happened
what brought down AIG? It was, I think,
right. So that was part of what happened in 2008. That, well, people were investing in riskier credit, with mortgage-backed securities and wherever it is, but they felt that they were only taking because they were buying credit default swaps, from whoever it was. I don't know, Bear Stearns, Lehman, AIG.
It was everyone, right? That was the deal.
Everyone.
Everyone was selling them.
Right. So they were buying, so they felt that they didn't even have that risk on, that they were insured, and they took off that risk off the books. So in 2008, when the crisis hit, what people realized was, well, when the market started going down, right? The market started going down, and then all of a sudden the mortgage-backed securities, those mortgages were defaulting at a much higher rate than anybody expected, because they were just creating no-doc loans, and all these kind of resets on interest rates, and they're doing ridiculous stuff. So the mortgage market started collapsing, and then they said, okay, well, but I'm insured against that because if they default, I have insurance. And and then they went to the companies that are insured. It's not the government insured. So the companies could only insure up to how much they have, right? If they don't have it, then you're not insured anymore. So those companies who were selling credit default swaps said, well, we didn't think that there was going to be so many defaults across the board at the same time, so we can't pay you, right? AIG didn't have enough money. They said, we're out of business. We're not paying anybody. Lehman Brothers, Bear Stearns, we're out of business. We're not paying it. Your insurance. So imagine your house burned down and your insurance company said, well, all that money you gave us, we can't insure you anymore. So you lost on your house and you lost on your insurance. And that's started in 2008, where that, there's tons of money being put into these markets thinking, I'm insured. So money kept flowing into these mortgages. It bubbled up and the insurance was basically no good. The credit default swaps couldn't make you whole. So the government had to step in, start buying these mortgage-backed securities, guaranteeing the companies, that they had to guarantee AIG to save Goldman Sachs, right? Because Goldman Sachs had credit default swaps that they were buying from AIG. But if AIG went out of business, Goldman Sachs would have gone out of business because then they're unhedged.
Yeah, which saved Bank of America, right? It was like
Bank of America,
the house of cards.
It's a house of cards. And then if Goldman Sachs goes out of business, then you could see that it all collapses. Then people who have money, funds in Goldman Sachs, they can't access there. So it would just been a big domino effect.
Now Lawrence says, so it's like options writing and IV. The thing is, those are on lit exchanges, right? So it is a little different in that.
Yeah, it's kind of like an option, but not exactly, because it's like more like if it only kicks in an event of a default, right? So if the default risk goes up, they'll go up, right? They will go up because of default risk, but they're not, just tracking the stock. It's not like a strike price, where you have an option to buy. It's basically, it pays off on the event of a default. That's it. Like if there's no default, it goes to zero. If there's a default, it goes to whatever they owe. So kind of like, think of it, you're buying insurance on your house, right? Well, if it, or on your life, right? So if you die, it pays off. If you don't, then the premium is.
So Lawrence says, so basically credit CDSs were supposed to hedge the risk, but one side couldn't cover it.
Right. The insurance companies were going out of business. It was the insurance companies, the ones that were selling the credit default swaps, were going out of business. But those credit default swaps, those insurance companies gave the market confidence to go out and buy these securities, mortgage-backed securities, which created a lot of credit for people, getting loans. So, just like, think about, like car insurance makes people more comfortable, buying more expensive cars, right?
So basically that's how you sold, that's how the insurance company, because they were buying these mortgage-backed securities, basically. These no doc securities, and then they were taking off the default risk with these credit default swaps, but that risk really wasn't being taken off because the other side just disappeared.
The counterparty risk, right? It was the counterparty risk nobody thought about, because they thought, okay, I don't have that risk. I insured myself.
And it's funny, the people who were packing the mortgages were the same ones selling the credit default swaps, right?
Yeah, exactly.
I mean, they were packaging the mortgages with all this, bad paper in it, and then offering to take the risk over from the insurance companies for the default risk. And,
yeah, because they all priced in that people pay their mortgages and you have collateral or whatever. So they priced in that there's very little or almost no risk of, these mortgages defaulting on a wider scale, like they had a certain percentage, but what happened was that they did go and start triggering the point where there was more defaults than usual, which then started to, whatever the terms or clauses in those credit default swaps, they were starting to hit. And that's when they went, that's when things seized up. And yeah, that's why they're looking at the credit swaps, credit default swaps. And this is, look, though I'm not a bond trader, they have lots of these types of things that I don't even understand. There are other swaps in there that are important besides default. Like, people swap fixed rates for floating rates to take off, that risk. So there's lots of stuff going on there. I'm not a trader in them, but I'm just explaining it kind of on the surface level, general level.
Well, D, awesome job. Who knew you could talk almost 25 minutes about credit default swaps and really give the Chameleon community a look inside that part of the marketplace, which few of us understand. Thanks, my friend.
Yep. Thanks everyone for joining. Oh, we'll give Rob's question tomorrow.
Yeah, I copied down Rob's question. He gave a more of an explanation of what he was looking for. I sent it to you, and we'll try to look at a volatility screen tomorrow for Rob. Thanks for doing it, D. It helps everyone.
Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, Chameleons. Thanks.